Diversified miner African Rainbow Minerals has registered a trebling in its annual profits. In the year ended June 2017, the miner reported that headline earnings rose to 3.2 billion rand. That's up 204% over the same period in 2016. ARM attributes its improved performance to higher US dollar denominated commodities. It plays in a number of resources including coal, manganese, platinum group metals and copper, among others. The company says it's reduced its net debt to just over 1 billion rand from 4 billion rand in the previous year. Shareholders will likely to be smiling. ARM declared a dividend of 6.50 a share. That's up 189% on the previous year and marks an 11th straight year of payouts. Our markets anchor, Nompumelelo Siziba, caught up with CEO Mark Schmidt. She first asked him which divisions of the company contributed to the lifting of the bottom line.
Obviously, we're very pleased with these set of results. Driven by most of our commodities, we've seen an uplift in all, but particularly driven by the iron ore and manganese division. Platinum done pretty well at Two Rivers operations.
And what about copper? I see you suffered some losses there.
We entered the copper environment a couple of years ago, and the copper's gone through quite a difficult transitioning period, and we've found a lot of geotechnical considerations. We went public 2 years ago and said that we want to operate below the 50th percentile on the global cost curve, and any marginal loss, in particular loss-making operations, have to come right or we must exit. And true to that, we've been delivering on that. And so copper is a commodity we want to be in, but it's got to be positioned on the right end of the cost curve. And so, yes, we've made an announcement that we are exiting the copper. And there's a couple of conditions precedents that need to be met, but I'm pretty convinced.
So you and your partner Vale have decided to come out of the Lubambe mine, the copper mine. Just to expand on why that is.
ARM is a young, diversified company with growth aspirations. It's key in our strategy, and obviously we balance that in terms of getting ourselves well positioned on the cost curve. But in terms of growth, we have a number of opportunities we look at, both from an internal and from an external environment. And obviously we look at M&A opportunities, and we have a dedicated team focusing on that. So ARM is currently busy with a number of investigations, looking out for something. It must meet our criteria, obviously.
Let's go back a little bit to the earnings. I mean, while the US dollar price of most of the commodities that you produce rose and assisted your bottom line, you do mention that the rand did appreciate by about 6% under the period. So it kind of offset some of your headline earnings. And you also mentioned that you had some impairments as well. Please expand on that.
So the strong commodity prices more than compensated for the strengthening of the rand. Added to that, we were well positioned in terms of our production or performance capabilities to meet that and benefit out of that. So the earnings was really driven on a volume basis, but the operations cost containment were well managed. And I think you have those two recipes. You've got to be ready for this market uptick. So if your costs must be well maintained, your volumes have to be there, and then you can benefit from the uptick.
That brings me nicely to my next question around controlling costs. How did you manage to do that? And to what extent did that have anything to do with job losses? And I also see that you managed to whittle down your net debt from over 4 billion rand down to just over 1 billion rand, which is quite impressive.
Our focus has, over the last couple of years, been on managing the areas that you can control, like costs, working capital, capital expenditure, looking at your volumes and making sure quality is there. And that's an important criteria in our game, is we get good premiums for quality because of the environmental aspects. So that has put us into a unique position in terms of good dividends flow coming out of Assmang and our Two Rivers. And obviously we've used that capital right now to reduce our debt, and which puts us in a very good position in terms of in terms of our debt equity ratios, and our gearing's now around about the 5%. So.
Now, going forward, what's the outlook for the commodities that you produce? We do see that there's a general kind of feeling that global markets are looking on the up, particularly China, where people believe that China wasn't going to do so well this year. It's proven people wrong and continues to thrive, and we know that that's a major commodity importer.
We've been fortunate that we have not needed to curtail any jobs in the past financial year. To the contrary, I think that we are slowly stepping up and seeing opportunities and re-employment taking place. So that's pleasing in an environment with such a lot of unemployment. We are cautiously optimistic. There's a positive trend out there. The demand side seems to be improving, and particularly in the commodity suites we hold. So we've both got early and late cycle commodities, and we're benefiting with that. And I think the key, Nompu, is particularly if we look at our iron ore and we look at our manganese, it's all around quality. And that's where we get big premiums on the current spot prices. And that's why the cash generation is so good. So now we're reasonably optimistic. The trend is in the right direction, and we're well positioned to capitalize and benefit from that.